Good afternoon. This is Gary Full. It's 12:15 Chicago time on Thursday, the week before Christmas, the 18th. And I sent this chart out to you, and I did a little video, but I want to really go into a little bit more detail because the market really was a nice schematic of the day. And having said that, there's always some type of schematic that happens in wyckoff lines every day. It may not always look the same perfect schematic or schematic that you personally like are comfortable in trading, but there are always schematics that happen during the day that we can take advantage of. Some may not want to do so, some may want to feel uncomfortable, whatever reason, but there are opportunities that happen. This particular case, we have a market. I'll just go a little bit further here, just before I get this all done. We have a market here that has markets drifting higher and eventually has a little springboard here. Okay, so the market kind of drifts lower. This market has a springboard here that should be bought, right? We talked about that earlier in a video earlier. Then all of a sudden we have a market that gets us buying that overtakes selling. So buying overtakes selling at this level right here. Once that occurs, we can call that the sign of strength to the market. It's on the right-hand side of the market. So it's on the side of strength to the market after a sideways action, the sign of strength to the markets. Now the market comes back down, goes back up, and hits the resistance area. Okay? And the market comes back down. And really, this was the opening of the markets. And I think that we now get to the point to where the market comes back down. But remember, since the sign of strength happened here, now you can say, well, Gary, the volume is more heavier here. This is the opening volume of the market. So the market probably, some stocks probably opened up higher, and the CM probably sold into that strength early. But the strength that happened earlier. This volume here, the range, is pretty good for 7:30 versus the opening. Market goes back down, we come back down, and we immediately go higher, and then go lower. And remember, this up, down close that occurs at the high is distribution. At the low will be somewhat of accumulation. Well, since it's happening in the lower aspect of it, the market is back and filling and being bought overbought. So we see the larger range upside than to the downside. So it's a 15-minute E-mini S&P chart. Very nice schematic to the market. Sign of strength, buying it, going up and buying it. Now, here is where the change of character happens. Remember, we have people that are long and they're buying new highs. We now have a market that has the same volume, marking up, and now looks the short of the thrust. Same volume, effort versus result. Effort versus result. Okay? Effort versus result. And we have it here. That's spelled right, but it's okay, effort result. Now we have these low end closes at the high. Low end, mid-range, low end. This is distribution of the market. If it was absorption to the market, it would be high-end closes, and they'd work themselves higher. Since they're alternative closes and mostly lower, it's the distribution that goes down to the market. We know that people are long. We get the long quotation bar here. Okay, this one. And the next bar is a short of downward thrust, effort versus result. Look at the volume. Higher volume, smaller range, SOT at the breakout of the of the sign of strength. This is a buy right here, a buy. Because the retest of the SOT and the retest of the sign of strength bar. And now we're going to this vertical absorption in the market. We're probably going to test the high. So just looking at this chart shows you a wonderful schematic of accumulation higher, distribution lower, and the retest of support to go higher. These are three opportunities during the day, and the levels between them, because the market's at a higher level, the levels that we have here is probably worth, the way the market moves, these are a couple $1,000 moves here. So really, on a one contract move in the S&P, you can range anywhere from $2,000 to $5,000 by trading one contract and just trading the schematic of wyckoff. It's a fantastic, as far as that goes, it's a fantastic markets to watch. And many times when you get to holiday markets, they are more true because CM doesn't go on a limb to advance or break the market down, nor does funds and specs get involved heavily because getting caught one way direction because the market's not really making a move. You're just back and filling the direction into the holiday. So it's a really great schematic, and I really hope you enjoy it. Any questions, please contact me. It's something that you really, really need to understand and learn. Not every schematic is the same, but there's also a wyckoff schematic on everything we do. So thank you for that.